All right, ladies and gentlemen, we are going to start the three types of trade setups webinar here. We do have a couple prerequisites for understanding these setups. Most importantly, on the sidebar, there are the three ways to enter into a trend. The PowerPoint presentations along the sidebar, the simple rules for trading futures. We're talking about the actual three types of setups. Okay. We'll answer questions at the end here. The goals today, to know how to identify the three types of setups, to know what to do with those setups and how to trade them, to know which trade setups to trust and which ones to pass on, and to know which setups to trade with a limit order and which ones to watch for participation. Now, most of you guys know that the three trade setups that we use every single day are the 50% retracement, the 61.8% line failure, and the extension. Now, the actual trade setups are a 50% retracement and the extension. The 61.8% line failure trade is actually a signal, and it's a signal to buy a 50% retracement, but it still is one of our trade setups. Okay. First, let's go over the traditional 50% retracement. The traditional setup is when we pull back off of an initial rally or sell-off. The opposite is true for short trends. So we come halfway back from lows to highs, or we come halfway back from highs to lows. We have some examples today of some very first short setups we've seen in a long time. A traditional measured move can be longs or shorts, of course. Normally, these setups are held to a negative 23% or 123% profit target. So you see an example here of a traditional measured move. From the lows, a rally off of a low, we pulled back into a 50% retracement. You can see the heavy participation at what was on this particular chart a 29.76. That 29.76 rallied to its 123% target, or negative 23% target, to complete its trend. Now, a traditional in a series of measured moves. Okay, this is where we link traditionals together. A series of traditionals is when we have completed a measured move to its profit target and pulled back into its next measured move, a new traditional measured move. The next setup completes its target. Now that there's two setups, it is now a series. That series is valid until it either one of two things happens. It either blows out of a target and becomes an extension, or it fails a 61.8% line in its series. A series can be longs or shorts. Okay, so a traditional series has two ways of ending. It either breaks its 61.8% line of one of its traditionals, or it blows out of its target to start a series of new extensions. Okay, let's see an example of a series of measured moves. First of all, we have bounced off of a 50% retracement, completed a negative 23% target, and then pulled back into the next measured move long. Completed a measured move to its target, we pull back into the next measured move long. We rally into the second traditional measured move's negative 23% target. It completes its target. Once two have traded, it is now a series. What traditionals not to trust? Now, the types of traditionals that we cannot trust are when a next measured move blows out of its target. We're going to show an example here of what not to trust. That means that a market blows out of its target and starts new extensions. We can't trust a new traditional measured move if it's blown out of one of its traditional targets. The second traditional that we can't trust, a series that breaks, of course, its 61.8% line. It's a dirty setup. It's failed a series. We'll show what to do with that failed series in a minute with the 61.8% line trade. We can't trust a traditional that runs into a larger time frame's profit target. What that means is that we had a series of measured move longs that have run into a larger resistance level or a larger profit target. Okay? We can also not trust a traditional in a series that runs into larger time frames, support or resistance levels. And we have some great examples of that today. Let's look at some examples here. Traditionals not to trust. In this particular example, this traditional measured move blows out of its target. As you can see, the 1296.50s. If it blows out of a target, it trades a new extension. Okay? This market will go straight up in extensions or not at all. Markets go from traditionals to extensions to straight up. If an extension fails, you can no longer trust the next traditional measured move with a limit order. If an extension has failed, if it blows out of its target, the new traditional measured move, if it trades into a pullback, cannot be trusted with a limit order because the extension has failed. Okay. Let's look at another example. A setup that runs into a larger time frame's profit target. We had a pullback, okay, which came after a larger setup's profit target had been hit. Now, we could be in a series of measured move longs up into that larger setup's profit target, but after it's completed, because it's bigger, it has more power. The next measured move in a series cannot be trusted off a larger setup's profit target. As you can see here, the larger setup's profit target completed, which resulted in profit taking, in a break of the series of measured moves. The actual next setup after the target was completed was below us at the 1246.50s. So after this target was completed, we have to know what our larger time frames are doing because they are more powerful. The larger time frames always trump the smaller time frames or are more important. Okay, let's talk about the next type of trade setup here. The 61.8% line failure. The 61.8% line failure is a trade that is the result of a failure of an opposing measured move, which means that a traditional has failed or an extension. 61.8% line failures can be longs or shorts. These setups signal a new trend or a confirmation of a continuation, meaning that a 61.8% line breaking can give us a new entry into a trend. These setups many times help us into larger trends. They're usually the very first pullback after a trend break. And the saying, the analogy, the mantra that we like to repeat over and over, when one door shuts, another one opens. Opportunity. When a trend ends and fails at 61.8% line, a whole new trend begins. They are very high participation events. Let's look at some examples. First of all, coming off of a traditional measured move long, we have a bounce off of a traditional measured move long. As you can see here, the opposing measured move short drawn from the highs to those most recent lows, the opposing short breaks its measured move at its 61.8% line. What that is signaling to you is to buy the next pullback. The next pullback after the trend break is one of the highest probability trades that we have, and it leads us into the continuation of that original trend. So if you've missed an initial daily long or daily short or 15-minute long or 15-minute short, you can trade the next setup after the trend break, and it's a very high participation trade. This particular 61.8% line break led us into a new 50% long that led us into target. That very first setup can be held all the way to the larger time frame's target in many cases. The first pullback can be held into the larger setup's target. Let's look at another example. Another example here, this is the 50% long. We can't see the bottom here, but a 50% long trades off its 50%. We rally up off of our support and break a 61.8% line of a short. We break the opposing measured move short at 61.8% line, signaling to buy the very first pullback. The first pullback is an entry into the continuation of the trend. As you can see here, the support traded, so trading hours only time frame, gap up, targets hit in the morning in this particular example. One of the highest potential or the highest probability trades that we have. The next setup after a trend break. What 61.8% line trades not to trust? This is very important when we talk about what setups that we can't trust with a limit order, that we have to watch them trade. If a 61.8% line failure turns into a retest of a previous highs or low, we cannot trust the next measured move or the pullback. It will more than likely retest its previous support or resistance before continuing its trend. We have some great examples of that today. Let's look at an example here in the next slide of a 61.8% line not to trade or not to trust. In this particular example, we bounce off of 50% long. We're using 50% longs here because they're easier to understand here. We rally up and break an opposing measured move short. Now, normally, this would be a situation where we would buy the next pullback. It does not start its pullback. It instead runs into its previous high. This is not a safe pullback to buy due to its coming off of resistance again. As in, if we briefly break the 61.8% line and make a pullback, it's safe to buy the pullback. But if we run all the way into a previous resistance, or just the opposite, sell off all the way back down into a previous support level in a short, we cannot trust that next measured move. As you can see, this pullback fails and it retests its original support before continuing its trend. So this is a case of whatever trades first. If it trades the resistance before the support, you can't trust the pullback. This is the only time that you can't trust the 61.8% line trade with a limit order. At any other time, it's an extremely reliable trade for first targets hit. Let's talk about extensions. Extensions are when we rally past a profit target and start a new 50% retracement that's drawn from the top of the last retracement to its new highs. Extensions can be longs or shorts, and normally these setups are held to a negative 23% profit target, or 123%. Let's look at an example of an extension. You can't see the bottom of this 50% retracement, okay, but we had blown past a target, and that lows to lows gave us a new extension to a target of a 34.81. It looks just like a traditional, except the anchor is different. It doesn't come from the highs of the last setup. It comes from the last low of the last setup that was completed. What is a series of extensions, and how do we identify it? A series of extensions starts when we have completed an extension to its target and pulls back into its next measured move. The next setup has a same anchor, but it's drawn to new highs. Now, there are two types of extensions. You could call the traditional extensions, one that does not blow past its target, and then an extension of an extension. The traditional extension is a setup that hits its target and uses its same anchor, but uses a new high. This series is valid until one of two things happens. It fails a 61.8% line, or it breaks out of its target, which starts a new extension. If an extension blows out of its target, it starts a new extension from its high in a series of extension longs to highs. Series can be longs or shorts. Let's look at some examples of extensions. In this particular example, we have an extension short that is already traded, and you can see it is sold off and run to its target. You can see how it is blown out of its target, the 24.42s. The new extension is drawn from the lows of that last setup, of the previous completed extension, to the new lows, and we wait for the market to run back up into its next measured move. An extension to extension is a limit order. Extensions to extensions are limit orders. Okay, let's look at another example here of an extension. This is how a new traditional extension starts. The extension uses the same anchor to new lows until they break their 61.8% lines. The second extension is drawn from the same lows of the last setup, giving us another extension short to target. The longer the same anchor is used to new lows, the larger the targets will be. Extensions can continue until they break their 61.8% lines. Some people get frustrated with traditional extensions, ones that don't blow past their profit targets, because they will give back up to 90% of their total move when drawn from the same anchor to new lows. It's only when we blow out of our profit targets and we start new extensions from lows to lows that markets really start to get going, and you have extension to extension to extension to extension. Let's talk about what extensions not to trust. Extensions begin, the very first extension begins when a traditional 50% retracement blows through its target. The very first extension that has just blown through its target is not a limit order. It is an observation for participation. Now, that only is the case with a traditional. You can trade an extension to an extension, or a traditional extension to an extension, but a traditional to its very first extension we have to wait for participation. Once that first extension is witnessed, this series of extensions is valid until the 61.8% line is broken. Now, you'll see this in many cases for the ES, where we have went 1 or 2 points into a target, and we literally wait for that very first extension to see if there's participation there. And once we see that participation, that same ankle will work for 2, 3, 4 extensions in a row. But the very first one is the one that is dangerous. Okay, it's an observation off of a traditional measured move. Okay, let's look at some examples here of a extension that blows out of its target in the very first test. This is a traditional measured move. It hits its target and then blows through its profit target, meaning that we'd normally see a new traditional measured move in a normal pullback. Well, it blows through its target. The first extension is drawn from the highs of the last setup, 2 highs. The very first extension is an observation because we can't depend on that very first test. We have to let the programs start it. As you can see in many examples, the very first test, if there's no participation, there will be a failure. If extensions fail, the trend fails too, and you cannot trust the new traditional. There will be a complete trend failure right below that 61.8% line. That is one of the rules that we have with traditionals to extensions. If we go from a traditional, we blow out a target, our stop goes right underneath the extension. Because if the extension fails, the entire trend fails. We go from traditionals to extensions to straight up. If extensions fail, the trend fails. Exactly as true as opposite in short trends. Let's talk about a version or a different version of some of our setups, and that's called the observation. Sometimes we find a support or resistance level that is not a traditional. It's not a 61.8% line failure. It's not even an extension. These setups are based on observations on algorithms executing orders on the market. We can only identify these trades, okay, based on observations. Sometimes markets find strange anchors that are executing at 50% retracements. Once we see that execution, if we can identify what the programs are buying or selling, we can identify its target, and we can trade those setups. Now, many times those setups, and this is why we have a prerequisite to the 3 entry strategies for retracements. Many times those setups, if you're not going to trade the first test, you have to either use the second test or trade the next measured move as it's moving away. Okay. Let's give an example here of an observation. This high here, it's not the 50% retracement, it's not an extension, it's not a 61.8% line failure. It's a random high, but based on an observation, we can see that the 28.11s have been sold into. As it's retested, we can see more participation. As it's retested the third time, we can see participation. The high is based purely on participation witnessed by an observation at the 28.11s. The participation level can be identified. The target can also be identified down at the 25.60s. And As it moves away from its series of measured moves, we can trade that series into its negative 23% target. So observations are based on what we witness in the market. If we can piece it together and we can understand what's being bought or sold into, we can also identify a target and use it to profit in the market. Okay. When do we use these strategies? The euro and the pound, the currencies, we adhere to the euro trading times, 3 a.m. Eastern Standard Time to 11:30 a.m. Eastern Standard Time. NYSE, okay, the New York time, Eastern Standard Time. We only trade these setups that we can see on 15-minute charts. They are the most reliable on 15-minute charts. It isn't necessarily restricted to 15 minutes. We're just talking about the medium-term time frame. You could look at a 10, a 12, a 17, a 20-minute, a half an hour. Time frames don't matter as long as it's not the micro time frame, the extremely small. The larger the setup, the more powerful and technical it will be. The smaller the setup, the less programs see it, or the less people or programs trade it, and the less reliable it will be. On the ES and the Russell, for trading the ES session, we stick to the NYSE trading times from 8 a.m. Eastern Standard Time till the end of the doldrums at 11:30 a.m. Eastern. And then after the daily doldrums end, from 1:30 until the end of the day bell. So we have a 8 o'clock till 11:30, and that's excluding the 9:30 open till 10 o'clock. And then after the daily doldrums, the 1:30 till the end of the day. Okay. We only trade these setups that we can see on 15-minute charts. What do we risk? We always adhere to the 1% risk money management rule. Okay? Because these are intraday swing trades, this is a reduced risk trading strategy. We're looking for first targets to get hit, to get free trades, or in the ES's case, a reduced risk trade, to trade it to its negative 23% target. Only 15-minute trends are to be traded. The larger the setup, the higher their probability and participation. Why is this important to our trading? Sometimes due to the extremely large range of a market, setups have extremely large targets, as in 40 points, 70 points, 80 points, or 200 pips, or 400 pips. In some cases, 1,000 pips. Some of the shorts we came off of on the euro. The market shows us our trend. The markets tell us in patterns how big their targets are. We don't decide how big our trades are. The range of the market and the draws of these measured moves tell us our targets. And we take advantage of what the market is making available to us. If it's making available little tiny setups to negative 23% targets, we trade them to their targets. If the market is making available extremely large ranges and large targets, we try to take advantage of those extremely wide ranges and large targets. These strategies help us identify intraday swing trades and make plans to stay in the market to their full target. Okay. These 15-minute trends and daily trends are the highest participated levels of any market, and they are very reliable in their first test bounce. That is the 3 types of trade setups, guys. I know for some it might be basic. We will go into some questions here. We're going to find a good place to end this webinar. Keep it nice and sweet and short.